Okay, I've received the go-ahead to start off. So, good evening, everyone, whichever part of the world you're in. I'm guessing most of y'all are from India. So, good evening. I hope y'all are, wherever y'all are safe and y'all are healthy and doing well amidst the lockdowns and the unlockdowns in the country right now. So, this session, we're going to broadly talk about understanding foreign investment. So, we're going to give you a very landscapish picture about what the foreign investment scenarios in our country are, what some of the things that we need to keep in mind, what some of the pros and cons are. So it's a very just a second. It's a very basic session to help you try and understand all the talk about FDIs, FIIs, and all the international investment scenarios that you currently listen to in the media and try to make sense of it. So brief overview of the talk. We're going to start off with a brief introduction to liberalization in India. Then we're going to move on to different classes of foreign capital inflows that are out there in the country. We're going to briefly talk a little bit about capital controls in India. We're going to then move ahead and talk about the role played by foreign direct investments in emerging markets, and specifically look at the case for India and how foreign investments can really help India. This is going to be covered by me, and then Rabani is going to very smoothly take over and talk about policies and incentives on FDI in the country, ease of doing business, and she's going to do a couple of case studies on the aviation sector. She's going to talk a little bit more about the retail industry and the roles played by innovation investment promotion agencies in the country. So to talk about liberalization in the country, for most of India's post-independence era, we have been a very regulated, planned, and closed economy in this country. And we've very actively suffered from what is called the Hindu rate of growth, right? So since the 1970s, the late 70s and the early 80s, we've looked at reform-oriented economic policies where we see that the industrial policies that were announced by the government, specifically starting off with the policies of the 1970s, beginning to dictate much of India's revival and growth and a push to move to higher and more sustained levels of increasing growth trajectories. So we started off with the industrial policy of 1977. Rajiv Gandhi came in, he introduced major reforms in the 80s, and then a combination of global trade scenarios, global macroeconomic scenarios, geopolitical issues, so along with the reform push in India, led to India's twin balance sheet crisis in the 1990s and the 1991, which forced sort of India to look at the IMF for a bailout or a structural adjustment package. Any component of a structural adjustment package in the country, or in any country, if you look at history and if you look at the history of the Washington Consensus, they basically ask you that in return for help to a struggling economy, you open up the markets in the economy to foreign investments, to foreign competitors, to basically try and making the economy and the markets as competitive as you can and as close to a free market as you can. So once India started adopting this Washington Consensus to suit India's needs, we had the structural adjustment program coming in with the help of the IMF. And we saw that in the landmark budget of 1990 to 1991, we had the economy open up to foreign investments and foreign technology agreements in 33 high priority industries. And this was done through a new industrial policy that was announced by the Narasimha Rao government in the 1990s and 1991s. And once this started to happen, this was also accompanied a year later by the setting up of the SEBI and regulatory agencies to control India's capital markets, and also to gradually open up India's capital markets to foreign investments. It is not just, India's aim was not just to look at foreign investments directly into Indian firms. They also tried understanding the fact that financial globalization was becoming the new norm, and hence you needed foreign investors to also start tapping into India's secondary and primary capital markets. So what are the brief classes of foreign capital inflows that are available to India? You have direct investments, which are basically lasting investments in the ownership and equity structure of the firm. You've got foreign investments, which are basically hot money, right? So these are investments that are made in equity inflows in stock markets by foreign institutional investors, by foreign agencies. And these are akin to any of the stock market investments that we resident Indians might make. So we invest and pull out money at any point of time. That exactly is hot money. You can invest the money at any point of time and you can pull out this money at any point of time. Just that this happens on a cross-border, cross-national scale rather than looking at an intranational scale. We have financial derivatives, and we've also got other instruments such as bonds, mutual funds, which are also very, very deeply invested into the Indian stock markets and Indian capital markets. So if you look at the evolution of FDI inflows into the country, we see that since 1997, so since the liberalization reform took over in 91, we had these 33 high priority industries opening up to foreign technology agreements and foreign equity investments. But the real push started happening since 1997, where you suddenly see a sustained increase in the investments from FDI starting to kick in. And this actually, while it fluctuates and while the data is only at a monthly frequency level, the fluctuation still gives you an upward trend, which means that the role of FDI, the importance of FDI in the Indian economy has only gone up from strength to strength. And these are just inflows. So monthly inflows, monthly lasting investments into the Indian economy. While FDI inflows on a monthly or an annual basis still account for a very, very meager portion of India's capital account liberalization, it is very, very important to note that a lot of the international investments which are made through FDIs in terms of FDI stocks, which is basically once you invest into India, in terms of whether you're investing into a firm and you set up a firm, the assets, liabilities, and reserves of all these firms put together today account for almost 14.3% of India's GDP, which is extremely staggering when we talk about an emerging market which only opened up its economy almost 30 years ago and still has had to deal with a lot of issues regarding growth, with regard to market access, with regard to credit market imperfections. So India has become quite a major important player, which is also recognized by the World Bank and IMF in terms of being able to become a destination to attract foreign investments and keep the foreign investment cycle in the global economy going forward. But as I pointed out to you earlier, and as I'll show you again in another graph, the net portfolio inflows in the country have been the most dominant inflows in the country post the liberalization era. So once we had the SEBI and the RBI starting to relax these capital control measures, we had a lot of foreign institutional investors and foreign portfolio investors, qualified foreign investors starting to invest very aggressively into India's markets, right? So while we see that since the 1970s, in the 1997s to around early 2003, the net inflows were approximately almost close to zero, or in say a couple of million dollars, we see that there is a violent spike going forward since 2004, which shows you that the net portfolio inflows into the country have fluctuated quite massively. If you're looking at that very high kink around 2010, it basically is a reaction to the global financial crisis and the impact of the global financial crisis on these emerging markets. So once you had the global financial crisis take over, a lot of the foreign investors started moving away from these advanced economies, say the US Treasury bonds, and they started investing in economies like India, which did quite well in mitigating devastating losses from the financial crisis. But then once the economies started to recover back again, you see this violent kink where suddenly you have a huge amount of capital flight away from the country for domestic and foreign reasons. But you have this huge amount of capital flight away from the country to these advanced economies like the US and the Eurozone back again. So this is exactly the picture that I've been talking about. So if you look at the annual foreign capital inflows, if you look at the gross FDI inflows, if you look at the gross FDI and FPI inflows versus your private domestic credit in the economy, the role of foreign investments in the country have only been increasing. While FDI in terms of inflow still accounts for less than 1% to 2% of GDP on an annual basis, we have these foreign portfolio inflows which account for massive amounts of money that are being raised by these Indian corporations who are listed on the stock markets. So while we see that there are a few Indian firms relative to the number of firms that are operating in the country today that are listed on the stock market, a lot of these firms which are listed on these stock markets are soaking up most of the portfolio inflows into the country. And you have these productive investments that are coming in terms of FDI, that are being distributed across different sectors, that are being distributed across different classes of industries. So it can be industries that are already big, it can be the MSME sector. So it can be a lot of these sectors which are soaking in the FDI, right? But however, what one needs to note is the fact that private credit and the private credit market still play the most important role when it comes to accessing credit for the Indian firms. What is important again for us to note is the fact that the role of foreign credit has only been going up. So if you look at the share of total foreign credit that is available to Indian firms, it was around 0.5% at the beginning of the early 90s when liberalization kicked in. It's now, in a matter of 3 decades, gone up to almost 20%, which means that almost a 20 times increase in 3 decades amounts to the fact that a lot of India's growth has been financed, has been driven by foreign investments coming into India as a prominent emerging market that India is. So to understand what the architecture of foreign investments into the country is, or what the contours of foreign investments into the country are, we need to look at briefly what the capital control system or the capital controls landscape in India is. So as an emerging market, if you look at emerging markets across the world, we see that most of them do not possess a free capital flows regime, but they have restrictions on the types and quantities of foreign inflows that move in, foreign flows and foreign capital flows that move in and out of the country. In a lot of cases, if you look at the Central and Eastern European countries, while they were moving into the Eurozone or while they were transitioning from a post-communist regime to a more free market regime, all of them tried to dismantle their capital controls regime all at once. India, however, while it was liberalizing at a very, very similar point of time, and while it was gaining access to international markets at a very similar point of time, it did not go for that approach. So it did not dismantle all its capital controls at one go, which was a very, very smart move by the Narasimha Rao and the Manmohan Singh government and all subsequent governments going forward. In India, capital controls today have been a mix of both direct government policy as well as the SEBI and RBI. FDI policy in India today is driven purely by the fiscal authorities, which are the government policies in the country. So if you look at all these government announcements that have been made, even post-COVID, in terms of the economic reforms package, or if you go into the history of FDI liberalization in the country, most of these announcements in terms of adjusting ceilings, allowing investments through foreign automatic approvals, or through approvals from the Foreign Investment Promotion Board, have been made by the government of India, where the monetary or the market authorities have had not much of a role to play with regards to pushing up the ceilings or adjusting a lot of these ceilings. But however, in India, the interesting case is the fact that foreign portfolio investments, since the setup of the SEBI and since RBI started looking at the FEMA, and which is the Foreign Exchange Management Act, most of it has been set at a cap of 10%, which is looking at any individual foreign investor can only invest in up to 10% of a company's equity. And in terms of foreign investors, if you are going through the FDI inflows channel, all foreign investors put together can only invest in a maximum of 24% of the company's equity. These are the rules that have been set by the SEBI and the RBI, and they have not sort of gone up and down in terms of thresholds. What the SEBI and RBI have done is they have looked at a lot of these types and quantities of flows, for instance, external commercial borrowing. They have looked at controlling the influx of dollars. They have tried looking into bond markets and securities markets, and they've tried adjusting and tweaking a lot of these other daily flows rather than trying to adjust or improve the ceilings that are available to these foreign institutional or qualified foreign investors. The interesting thing over here, however, is that FPI regulations are still subservient to FDI regulations, in the sense that if the government does not open your investments, does not open your industry up to foreign investments, once you are into this regime of foreign investments, only then can you attract a lot of these qualified foreign institutional investors or foreign portfolio investors. So capital controls in India have always placed much more emphasis on FDI first, and then only once you have started opening up your economy to FDI, does FPI start kicking, do these FPI regulations that are operated by the SEBI and RBI start kicking in. So capital controls in India is a mesh between the government and the regulatory authorities and the RBI at this point of time. And India today is a unique setting if one wants to study the impact of capital controls in emerging markets. India today stands at a very unique setting because India's capital controls have been very quasi ad hoc and almost close to random. If you look at the political economy of capital controls in India, they have always been driven by responses to crisis situations. If your growth rate is falling, if you suddenly see you're facing a lot of backlash from domestic investors, from domestic industry, or from your domestic electorate, the government will suddenly go and start reopening a couple of sectors or a lot of sectors at one go. For instance, what happened in 91 as a result of the crisis, in 1997, when India opened up quite a few more sectors in manufacturing and hotels and tourism to FDI, what happened in a major push in 2006, and also after that, what happened post-COVID, where India took a lot of these sectors and just liberalized foreign direct investments into the sectors and removed all caps, allowing almost 100% foreign investments into the country. So a lot of this, the political economy can be debated, but a lot of these sectors have been driven by a quasi-random approach in terms of how you drive policy in opening up your economy. And this is exactly what I'm trying to show in this graph. If you look at this graph, you see that inward liberalization in the country has only been gradually moving up since 2000. While this data is taken from the IMF and you look at the trajectory of the graphs, you see that inward liberalizations on hot money, which is basically looking at foreign portfolio inflows, they have accounted for a major portion of a lot of the inward liberalizations and inflows that have happened. So while India has had approximately 160 to 170 episodes of liberalization, both in direct and portfolio investments, according to the IMF, between 2001 to 2015, a lot of these have been driven mostly by the SEBI and the RBI in trying to control for stock market volatilities and stock market inflows with regards to foreign portfolio investments, which are in the capital markets, right? So what is the role played by FDI in emerging markets like India? The question is always a politico-economic one. The question is always an economic one as well. What is important for us over here to understand is the fact that while we cheer for FDIs in the country, one needs to understand why we're cheering for these FDIs in the country and why India, from an emerging market standpoint, needs a lot of these sustained foreign direct investments that are coming into the country. So the first sort of very textbook Econ 101 neoclassical economic approach is trying to supplement domestic capital sources. So in terms of emerging markets, they are not big enough in terms of economic sizes to fund a lot of their projects to generate investment and positive economic impacts. So if you look at emerging markets in Africa, if you look at Brazil, the economy is not big enough to have a lot of domestic investors try pumping their money into a lot of the projects that are needed to push the economy on the technology frontier or the growth frontier, right? We look at India and we look at the fact that private credit has played a very important role since India's post-independence era. But even once India has moved into a liberalization regime, the private sector has picked up a massive amount of the burden in terms of trying to finance India's growth. But this has begun to change in the last decade and a half, where you look at firms moving towards secondary capital markets, where you look at firms trying to attract a lot of these FDI investments to joint ventures, proprietorships, partnerships, in terms of attracting investments from foreign firms, from foreign investors who can supplement the limited capital resource constraint or the limited liquidity or the financial constraint that these firms might face if they have to move to domestic markets. There are also very important factor market imperfections. So for instance, you are a firm that needs money, but domestic lenders might not be comfortable lending money to you because your risk rates are very high. So these are a lot of these market imperfections and gaps which allow foreign investors to come in. They not only allow you to assimilate a lot of the market imperfections, alleviate these market imperfections into better market conditions, but they also recognize a lot of these projects which they feel can not only push the economy to larger frontiers in terms of technology and markets, but can also give them very high returns, which is why a lot of them start investing into these domestic projects going forward. Another very, very important role for FDIs is the fact that there is an influx of foreign technologies into production. If you look at the new industrial policy of 1991, and if you look at a lot of the subsequent industrial policies, we see that foreign technology agreements played a very, very important role, which means that the government was not only trying to attract foreign money, it was also trying to attract a lot of these foreign investments in terms of technology upgradation into the country. As an emerging market, as a developing economy, because of the fund crunch, because of a lot of the other reasons in terms of capital and domestic technology, you might not be at the forefront, or you might not possess some of the cutting edge technology that is dominated at the rest of the world. Where technological transfer and technical change allows you to look at these impacts on developing economies. And there is always a missing market in terms of technological know-how in these countries. In India, we don't invest as a government a lot on invest a lot on R&D. Historically, we haven't done that. Where do you supplant this investment in R&D into the country? You try attracting foreign firms, you try attracting foreign investors from the West, and in the advanced economies, countries which are at the cutting edge technology frontier in terms of their different industries, and you ask them to invest in India. You ask them to come in and apply their best management practices, their best production practices into countries like India, and then push India onto the technology frontier. You might have definitely, if you were following the news around 2011-12, looked at the debate around FDI and multi-brand retail, FDI and single brand retail. You might have been looking at the parliament debates where the late Arun Jaitley was talking about the impacts Walmart might have in terms of trying to galvanize Indian retail sector, in terms of storage and transportation. And this is exactly where the debate on infrastructure development in emerging markets like India comes in. Historically, because of the fact that these economies don't possess too much technical know-how, these economies are still developing, they don't possess a lot of infrastructure, or they have to invest more heavily in infrastructure to catch up with the advanced economies as compared to a lot of the other emerging market economies. So a lot of the policies aimed at attracting FDIs in the country, which I'm pretty sure Rabani is going to talk about once she takes over in a few minutes, a lot of the policies aimed at attracting FDI have also been accompanied by sister policies aimed at upgrading infrastructure. So when we were looking at multi-brand retail, we were looking at debates on storage and warehouse. We were looking at better access to roads, better access to electricity, how these firms can come in and make sure that they don't incur sunk costs in terms of just setting up their firms at low cost land. And better infrastructural facilities, and this is basically a virtuous cycle. The moment a government starts investing in infrastructure facilities to try attracting a lot of these foreign firms, better infrastructural facilities also make sure that you have a lot of these foreign firms come in. So this is a very, very circular and virtuous process where you enact sister policies to make sure that a lot of foreign firms are coming in, but a lot of foreign firms also look at these sister policies that are getting enacted, and they try to, and they now get incentivized to invest in the country because they know that the infrastructural facilities will make for smooth production operations in the recipient economies like India. We look at institutional development in India, right? And we look at things like ease of doing business, which Rabani is going to talk about, but I am also going to broadly motivate why we look at things like ease of doing business. Institutional development is a very chicken and egg situation. You don't know which comes first, foreign investments or institutional development. A lot of people say foreign investments help institutional development. A lot of people say institutional development is a precursor to foreign investment and accelerated growth in the country. But the fact is, it's not, as much as the causal relationship might not be established between the two, there is a very, very strong correlation between better economic institutions and in terms of the FDI policies and projects that are attracted by emerging markets. We have to understand that India, like any other emerging market, has a lot of risks involved in terms of projects. There are insolvency issues, there are issues in terms of plant shutting down, there are a lot of these archaic regulations in terms of companies, in terms of labor, that can create a lot of hindrances for these projects and these foreign investors to recover their money. So institutional development is something which is very important. And the government of India has invested a lot of policy and political capital, like all other emerging markets, in trying to create better and stronger institutions so that their country seems more attractive to foreign investors. The other advantage, which is very, very important over here, is that these institutions also have a spillover effect on your domestic firms. Once domestic firms start to take advantage of these better institutions through these sister policies, so if you're looking at regulations on labor laws, if you're looking at regulations on water, power, electricity, if you're looking at regulations on raw materials, insolvency and bankruptcy, a lot of these domestic firms, which are way more in number, also start to take a lot of the spillover effects, which are very, very positive. And once these firms start expanding in terms of size, in terms of activity, and they generate more growth, the country also starts to increase in terms of its economic size, in terms of its market size, and hence, again in a virtuous cycle, attracts more foreign investments and foreign investors to take advantage of these larger markets, because a foreign investor wants to see the market size. This is very, very similar to what one sees on reality shows like Shark Tank. A lot of the investors ask you, what is the market size? What is the potential sales of your firm? What is the potential sales of your product? This is very, very similar to what happens in FDI and for FII investors as well. They look at the prospects of the firm, but they also look at the prospects of the firm in relation to the market in terms of trying to figure out where the company can help them grow, where the company can help their equity profiles grow, and where the company can help them make more profits. Because at the end of the day, a lot of these foreign investors are just looking for profits from the Indian economy. Now, before I end, there is something which is very, very important, and a lot of people actually don't cover this aspect of importance of FDIs in emerging markets, which is through the global value chain. Once we start looking at the global value chain, we see that the changing nature of globalization since the 70s and the 80s has dispersed a lot of these trade networks across different parts. So if you look at a very, very layman's example of Apple, Apple does not produce all its spare parts for a phone in one country. It produces some components in China, produces some components in the USA, and it assembles a lot of its components, and it assembles its products in California. The point is, if you're looking at standard trade theory today, if you're looking at standard trade practices today, the production activity of Apple is dispersed across different countries. And a lot of emerging markets, and not just in the case of Apple, a lot of emerging markets like India, China, Vietnam, have all been vying for major chunks of global value chains in terms of trade flows for the past few years. And these value chains being split apart cross-nationally, where the exports of one country become the imports for another country in terms of trying to add value. We have seen in the recent debates where there is a lot of debate going on in terms of India being the second largest market for headphones in the for smartphones in the world. We are looking at countries like China and how trade might play a major role in China. But the biggest example here, or the biggest takeaway, is that India currently today stands at the junction of a very, very high global value chain. So if you look at the bottom left of the circle, you see that India today covers approximately 2.3 to 3% of the global value chain. But India is not a big enough player in the global value chain as you see in terms of Japan, Singapore, South Korea, Hong Kong, Thailand, Malaysia, or even countries in the European Union. So as an emerging market, India needs to move up in terms of the global value chain. India needs to move up in terms of trying to dominate global trade, to say move from 2% to 4% or 5% of the global trade in terms of goods and services that are happening in the world right now. And this is where FDI comes in. If you look back at the point that I said about supplanting domestic capital sources, FDI into sectors like manufacturing and trade can play a very, very important role for countries to internalize, specifically for India, internalize major chunks of these global supply chains into their own borders. And what is important is that we have seen this work. We have seen this work in countries in sub-Saharan Africa, where policies to create opportunities to attract GVC investments, where policies to attract FDI has been a very, very big role in promoting a lot of their growth in emerging markets in sub-Saharan Africa. So while a lot of these countries in sub-Saharan Africa are still dealing with institutional backlogs in terms of growth and development and poverty, the global value chains have gone into sub-Saharan Africa and they have become very, very important players in these countries. Even though Africa today and African countries don't play such an important role, the sub-Saharan African economies today are running a lot of the rise in terms of foreign investments and global value chains. So now I'm going to ask Rabani to take over, and she's going to talk a little bit more in terms of trying to paint a broader landscape of FDIs into India.
Thank you, Sharon. That was beautifully put. I'm going to look at some of the policies and investments, incentives on FDI in India. So far, there have been approximately 15,000 procedures and policy revisions. Sorry, this needs to go back. Right.
Yeah, it's going to be the next slide.
Yes, I think there's a technical glitch. Yes. So, sorry. So I'm going to speak on policies and incentives on FDI in India. So far, there have been approximately 15,000 procedures and policy revisions to make India an attractive destination option for FDI. Apart from those that are listed on the slide that is on your screen, there are some other noticeable ones that I'd like to highlight. The corporate tax rate has been cut down to 25.17% from the previous 34.94%. This has made India now with one of the most competitive tax policies for investors in the world. Speaking of electronics manufacturing, the production-linked incentives of up to 41,000 crores will be awarded over a period of 5 years, which is great for us. FDI limit in defense manufacturing under the automatic route has been raised from 74% to 49% now. The government has released the National Infrastructure Pipeline, which plans an investment of approximately $1.4 trillion in the infrastructure between 2019 and 2025. Going forward. So the number talk. I mean, Charan has very nicely put about FDI and where India stands. I'm going to speak on the numbers which kind of showcase where India stands now in terms of the FDI. There are $161 billion investments in pipeline. There are already 264,000 actual jobs created. In terms of the business requests that have been received, there are approximately 23,000. 2017-2018 was a great year for India because we achieved the highest FDI inflow for the financial year, which stood at 62 billion. So ease of doing business. Here we can see the positive impact that all the policies and investments have played. The success of these policies is actually evident in the number game. India has risen 30 places in the ease of doing business ranking, which is by the World Bank. We have risen 32 places in the Global Competitive Index, 21 places in the Global Innovation Index, and 19 places in the Logistics Performance Index. So I'm going to discuss briefly the aviation sector. In the aviation sector, India has loosened regulatory requirements such as the government approvals and the monopolies that were held by the government previously. With the opening up of the economy, it has led to the market entry of Air Asia, Singapore Airlines in the domestic aviation market. domestic market, which has provided a great which has provided great exposure and a lot of other incentives, such as absorbing the spare labor force that was created by significant layoffs by the major airlines. So, speaking of the retail sector, consumer spending is expected to grow by almost 4 times by 2025. And the online buyer market is expected to grow 7x from 90 million users to 350 million users by 2025. With these numbers, India is predicted to be the third largest consumer economy by 2025. In order to attract more investments, major reforms have been made, making retail sector 100% FDI with almost all subsectors included. There you go. So this is the foreign investment reforms in the retail sector. As you can see, there is 100% FDI in almost all of them, except for the multi-brand retailing. So, role of investment promotion agencies, IPAs. IPAs play a big role in countries that are complex in nature, per se India, be it the bureaucracy, corruption, or red tapeism. This can be very confusing for any foreign investor looking to enter any given market. For example, India. Hence enters IPAs. IPAs, as I mentioned, are investment promotion agencies. They act as the focal point of entry, intermediary between foreign investors, central government, state governments, embassies, and other agencies. Not only do they help with market surveys or approvals, but also issue redressals post the company inceptions. Hence, IPAs play a very big role in FDI facilitation. India's IPA is Invest India. So this is a slide on Invest India, and it gives you a brief on what exactly an IPA does and entails. Invest India, with all the work that they have done, the investors have actually ranked out of the best globally. So that's something we all should be really proud of. So much so that Invest India received the United Nations Conference on Trade and Development's Award on World's Best Practice IPA in 2016 and in 2018 for promoting investment in sustainable development. So this is a case study. I want to give you a brief on the issue redressal and handholding bit of IPAs. We all know that IPAs are there to facilitate any foreign investor into the country, but the role doesn't end there. There is a long-term relationship that goes on with the investors. And in a country like India, where there is a lot of red tapeism, there also exists a lot of issues. So this is a brief case study on Marks and Spencers, which is basically a British retail high street retailer. So M&S was asked to shut down 2 stores, namely in the Delhi airport and the Mumbai airport, because their joint venture with Reliance Retail expired and they were operating on a professional extension. With M&S, with this, M&S was going to suffer a loss of approximately 10 crore rupees every week, which is a huge amount. So when Invest India, which is our country's IPA, intervened and reached out to the concerned agency, M&S got an interim permission to operate both the stores. Now, here we also need to understand that the IPAs have a great understanding of the relationships between the central government, the state bodies, the embassies, or any other government body in each specific sector. So, how they work is that there are sectors and then there are countries. So, once the company enters, they divide it into the sector. And alongside, the governments and the ministries work with Invest India to facilitate and later on do the hand holding and the needful bit, be it issue redressal as well. So I also would like to speak on another case study. This highlights how IPs help a foreign investor enter a particular, in our case, India, economy and set up their businesses. So Indo-UK Health Project is basically the world's largest healthcare project with investment plans of almost $2 billion. They plan to set up 11 healthcare institutions and 89 diagnostic clinics across 11 states in India, which is a big thing. So Invest India here provided the Indo-UK healthcare project with special competitive analysis of each of the 11 identified states in terms of whether it's the regulatory environment, the incentives, the availability of the skilled manpower. It is also developing a business model for the 5,000 healthcare clinics the project has proposed to set up across India. So Invest India is also facilitating with the break-even costs of the land, the special packages from the state governments and environment clearances through meetings with the MOUs and the MOUs. So this was basically just a brief idea on the policies and the role the IPs play. What I want you all to understand is that FDI is an overarching terminology. Within that, there are so many umbrellas, so many branches, and IPS play a really big role in helping and facilitating FDI. So it's a win-win situation when the IPS come in. One, for the foreign investors who, of course, are looking to set up the business, and second, for the country also because it helps bring in FDIs. Well, I guess that's about it. And now we will move on to the question bit. Does anyone have any questions?
Questions, comments, observations, everything is welcome. So
Welcome.
Hello. Are we live? I'm guessing this is unmuted. Okay.
yes.
Okay. Thanks so much, Sharon, and thanks so much, Ravani. I think this is a great session. Okay, I think we have a question first coming in. I think you guys can take that first. And there's a very generic question. I see Sharon smiling already. I'll ask him to take that question first, then I'll come.
How do I see the Indian economy bouncing back in fiscal year 21? It's going to be a tough road ahead, in my opinion. If I have to talk about foreign investments are drying up massively. And because of the fact that the rate of returns and the risk profile on emerging markets are going even further up. So if you look at Moody's and Fitch and S&P, they have also downgraded a lot of the Indian investments, and they're now flowing to places like US Treasury. It's a tough road ahead for emerging markets in trying to attract foreign capital inflows. And recovery now will not only depend on how the government plays its role, but also in terms of how we are looking at a second wave or a potential third wave, whatever holds in terms of India's future, and in terms of how that affects the advanced economies and how that affects the global value chains. So right now we were looking at a V-shaped recovery. Suddenly it's gone to U-shape. Someone was saying W, but now in the advanced economies, it is like they're saying it's going to be an inverted tick. So it's for everyone's guess in terms of how India is going to bounce back, and no amount of speculation is actually going to do us any good. But the global headwinds don't really point in a favorable direction if the advanced economies still continue. If countries like the US don't stop in terms of the rise in the number of cases and economic activity, it is definitely going to have huge ramifications in India. Um, I see another question. FDI helping internalization of the global value chain. I'm just going to quickly answer that. FDI helping in the internalization, I mean, in the fact that if you have a foreign firm which is trying to relocate, say, moving away from China, for instance, which is what we're seeing in the news, if a foreign firm wants to relocate its production and set up a new production unit in a partnership or a joint venture with an Indian firm, we are basically internalizing that part of the global supply chain into India's economy. So if we weren't producing Nike shoes at first, and if Nike decides to shift all its manufacturing into India, that is exactly what we are doing. We are internalizing a part of Nike's global supply chain into inside India's borders, and that can only be done through FDIs in terms of proprietorships or joint ventures or partnerships. And that's exactly, I think, where the policy is opening up. I'm trying to. Yes, go on, Rabani.
Shan, there's one more question for you. I'd say
Yes,
you answer all the questions that are addressed to you, and then I'll take over.
yes, I'm trying to scroll through the questions, and this is being okay. Yes, post-COVID, world will definitely be of deglobalization and localization. How FDI trends is going to pan out in such a scenario? Um, I think deglobalization is a relative term over here because for the past 20 years and what we saw with the financial crisis as well, we were in an age of hyper globalization. So a lot of countries, knowing the risks of the pandemic now, will start to look at servicing their own customers and servicing their own manufacturers first. So if you're stepping away from hyper globalization into deglobalization, you're not actually reducing a lot of the a lot of the global trade and a lot of the globalization components in terms of goods and services that we're talking about. The world is still interconnected as before. So if you want to shift in terms of production or global value chains, and you want to substitute these global value chains where countries are primarily producing for their internal markets, it's going to take a very, very long time, approximately 30, 40, 50 years of structural change. And over here, localization, I don't see personally, in my personal opinion, I don't see deglobalization and localization in terms at least of foreign investments happening anytime soon, because FDI, foreign investors, will still look to put in money in terms of these emerging markets in countries like India, which are definitely at some point of time, if not fiscal year 2021, at least in 21-22, they're going to start picking up. The growth is going to pick up. Indian manufacturing is again going to start on rebounding process. And that's again when you're going to see a lot of these foreign investors are going to start pumping money back into India. So it's a cyclical process, as we say in economics. It's a business cycle. There's going to be ebbs and flows, but even in terms of FDI trends, the advantage with FDI is the fact that these are lasting investments into the country, and they will not really stop as long as India is growing at a decent pace. What we need to also worry about are these foreign institutional investors, which have been pulling a lot of money out of Indian stock markets since demonetization and early 2017. So that is something India definitely needs to worry about, and the world needs to worry about in terms of how the stock markets and the capital markets are behaving, because a lot of these bigger firms are dependent on the stock markets in terms of equity flows, debt flows, and bonds in trying to in terms of trying to supplement their domestic capital inflows. So I don't see deglobalization and localization being much of a problem. Maybe it's going to not be localization, but regionalization, where we see regional trading blocks taking over. We see the Eurozone, we see the Trans-Pacific Partnership, we see a lot of these regional blocks starting to come in. But localization is something which is hardly tenable considering the way world trade is behaving right now. So that's all that from me in terms of my viewpoint on this. Now, yeah, Rabani, if you want to go on.
Yes. There was a question on the consumer spending rate. One needs to understand that the consumer spending is very sentiment driven. This is something that our government acknowledges and recognizes. That is why most of the FDI policies that you see are very liberal in the sense that we want to welcome foreign investments. The numbers that you see are projections, and they are based on right now the actual numbers, and again the projections based on the policies and the incentives that have been introduced.
Rabani, there's, I think, a twin question on FDI in China, and like a self-reliant India, if you want to take over that, it's
I
a
just
twin
saw that.
question. So I think from an IPA perspective, I think you'd be able to answer that quite well.
Well, right now we did see that a lot of apps have been banned, but FDI plays a big role in our economy, because that means that there's a lot of cash inflow and a lot of investments that are coming in. In my opinion, I don't see major issues happening there. But yes, India is focusing and really pushing for Make in India concept and the campaign. But FDI per se, we were good to go. Sharon, there's a question.
On China,
Makers pushing for reforms in crisis situation.
policymakers pushing for reforms, and don't you think? Uh, yes, it is such an effort. I don't disagree with the idea of Atmanirbhar Bharat. Keeping my own political views aside, the political economy of the problem with trying to push for reforms in crisis situation is the fact that your political economy is not directed a lot towards reforms, but towards trying to satisfy or um, satisfy or pacify your own vote banks, in the sense that there's nothing wrong with policies like Atmanirbhar Bharat. There's nothing wrong with policies like Make in India. Industrial policy is always a very welcome step, and industrial policies have been used by emerging markets a lot. If you look at South Korea's industrial policy, they have been big hits in terms of trying to propel growth. Um, the point, however, is the fact that a lot of this political reform has led to very random liberalizations. For instance, in 2000, we see the telecom sector moved to 20% foreign investment approvals. And suddenly, a year later, we saw the telecom sector moving to 26% foreign investment approvals. In 1997, only one category of GSMs was allowed foreign investments. So a lot of the ad hoc policy reforms that I'm talking about, a lot of these policy reforms, if you see, were happening, the major chunks in terms of, say, allowing 100% FDI inflows into all forms of manufacturing, which is contract manufacturing, almost allowing all of these inflows to come in, except for the MSME reservations in 2006. These were also in response to a lot of downward trajectories in growth, after which India saw a growth pick up to 9% till the financial crisis. So the ad hoc nature of the policies is exactly what has been problematic for India, in terms of the fact that there is no sustained policy. There has historically, across different governments, been no sustained policy reform in terms of how they are going to allow foreign investments to come in different industries across the country. Theoretically, allowing manufacturing to come in has definitely never been a problem, and it definitely never will be a problem. But knee-jerk responses, in my personal opinion, knee-jerk responses are something that government should try and avoid. And governments historically have been falling prey to a lot of these knee-jerk responses.
Okay. Sharon, Rabani, I guess that's about it in terms of questions, and we don't have any more. Okay. We already have a request for another session.
Yes.
From Deepa, who wants you guys to cover FIIs. I'm sure we can think about that and discuss that at length. But yes, guys, I think this has been a great session. I think it's been extremely fruitful, and you provided some much needed insights into a very relevant focus area. And I hope that your mentees continue to get this guidance on this particular subject and on sort of other subjects that they are focusing on. I believe my video is off, right? I'm guessing it's turned on now. Yeah. Okay. This is far off. Okay. Yes. Well, thank you so much once again for in this session. All such a great audience. Just two updates for our mentees.
If you have any feedback for any of our mentors or regarding any of the mentorship programs or any of the modules that have been conducted, you can feel free to write to me directly at president@iYEA.in. I understand that at times you can have some difficulty sharing feedback with your mentors directly. And if you have any other feedback about the program at large, you can certainly write to us at interns.iYEA@gmail.com, and we'll make it a point to incorporate all the feedback that we can. Just as today, we had this first session starting at 8 p.m. IST. Some of you were looking forward to evening sessions, and I think it was more convenient for some of our mentors as well. It's great to have you guys on board. I must thank you once again, especially Sharon. Certainly, I must thank you as well, Rabani, but Sharon's joining us all the way from Cornell, and you know how Indian mentality is about these things. I mean, though we've known Sharon for about, I believe, 6 odd years now, and he's been working with the IYEA since. But it's great to have both of you with us here. Also, just a point for our mentees, we've already shared the schedule for all our upcoming programs for this week. We have Dhananjay joining in tomorrow with international security, post which we have a guest lecture on the integration of princely states by Mr. Deepak Verma. And then we look at competition law to be covered by Dhruv Chadda, who's an incoming advocate in competition law at one of the most established firms in that particular field. So we hope that all of you will be joining in for all of these sessions as well. We're experimenting a bit with time to see whatever works for most of you, and then accordingly for the weeks that follow, we shall structure our timing accordingly. We've taken in all feedback from your side, and if you're looking at more sessions or you're looking at specific sessions on specific topics, feel free to let us know. Most of these topics are framed around the suggestions that you have been giving us and the research interests that you all wish to focus on. If you're looking at FIIs or if you're looking at other such things, I saw there was some discussion on logistics, supply chains and the like, especially the relevance in the COVID scenario. So we might be planning a session in that regard as well with one of our trustees who has got some domain expertise in that area and has worked in that area. If you guys are interested in something like that, please feel free to write us. And if there's any other area that we haven't covered up until now, you can write to us in that regard as well, and we'll try to incorporate that as well. Thank you so much, everyone, once again for joining in. And thank you so much, Sharon. And thank you so much, Ravani, for a fruitful and an insightful session. Right. Okay.
Thank
Good
you.
night, everyone.
Good night. Thank you.
It's going to be morning for Sharon.
Yeah.
Okay.